Hello, everyone, and welcome back. We are on episode 13, Talking Trends podcast with Mike and Jerry. How are you, Jerry? It's been a rough recent go in the markets here, at least for us.
Oh yeah, the
How are you
markets have
doing?
been a little the markets have been a little counter trend
Mhm.
and giving back some of our profits in the longest held positions. Tremendously successful trades. We let them go against us a bit before we get out. Good to be back. You and I talk a lot, but we get busy. And but I know Oleg and some of our Twitter friends will be so happy. Oleg will break this down into like 800 tweets and end it with, everything Jerry said was correct. Yeah. So he loves this podcast, this format, back and forth, you and me. It's different than all the other things that I do. Uh, I,
I
you
think
know,
I've gotten some nice compliments recently. We'll get to it. One of my LinkedIn posts that went, quote unquote viral recently is that one people are so used to being talked to by investment professionals similar in a similar way, very polished, very you know uh, very great vocabulary, great talking points. They're very buttoned up, and then here I come with my f bombs and my punk rock analogies and things like this, and um, you're definitely more polished than me. But I think you have a similar way too, where you don't need to behave a certain way to to cater to anyone specifically. You want to just be yourself, and try to be helpful, try to be nice, but be yourself too. And I think a lot of at least investment professionals are just not willing to go there. They're afraid of maybe appearing stupid. I am too sometimes, but I try not to let it hold me back.
right. Um, well, yeah. I mean, I think you come across. You want to be yourself, and that this is how you're going to come across. I have my issues on how I come across. I get too excited. I watch other people on podcasts and I see what I like, and it's like the opposite of what I do. I try to behave myself. I try to be low key. So maybe I'm just getting away with kind of behavior that's not as appealing in a podcast. I feel like that sometimes. I get too excited, too intense. Um, I don't come across as an Ivy League president.
No, but you don't
They're
need
so
to be.
rehearsed with the perfect answer,
You don't need to be.
and I
I
try to
think
be, I try to be funny as well. And that's probably something you should never try to be is funny
well,
in a
funny's nice.
professionals.
I mean,
In a,
these are all. It's probably sounds silly to talk about it. Being two traders, and where performance is our badge of honor. What we care most about. But I will tell you that a lot of conversations I have with people is that they don't care about it as much as we do, and
about what? About
about
performance?
performance.
What do they
They're
care
not as
about?
uptight about it. We get so uptight, like, oh, we had a bad month, we had a bad quarter, had a bad year. And most people are like, yeah, but I trust you. I love doing business with you. I know you're going to win in the long run. Like, oh,
Ah.
really? Because I just put myself through the fucking ringer for the past year. Like, man, I suck. I'm so worthless. Everyone must be talking shit about me and all those things. And I feel that it's just nice to maybe it's the certain investors that I have too that are just they value other things other than just the performance numbers. And yeah, that's I think that could be head scratching or surprising to traders and aspiring fund managers or new fund managers, or even old guys. They just get so used to the performance being the only thing in everything. Um, No, it's not as true. I think that was mentioned in one of our favorite books together. One of the books we like is How to Sell the Invisible. And I remember there being a study that the author quoted in that book. I believe it was a Goldman Sachs like client survey and performance in terms of like what their clients valued, top top 10 things, and I think performance was at number 7 or something like that. And it's like,
Okay.
really, man, I wish
Yeah.
I kind of wish it was higher,
Yeah.
but sometimes when you have a bad stretch or something, all right, okay, yeah, well maybe they're not as uptight and pissed off about it like I am, but um,
Well, for sure, we know that all the people who have most of the money, uh, or people like us who don't have enough assets under management, given our track records, that uh, we're not benefiting from that net because we should have a lot more money based upon our performance than we do. And so, institutional quality firms, firms with lots and lots of PhDs or websites or whatever, they have a tendency to raise a lot more money than because people don't look at the performance only. That's for sure.
yes, well, this kind of maybe dovetails into a mention the one of the posts I posted. This was a month ago, and most of my posts, at least on LinkedIn, in terms of impressions, get like several thousand, maybe 5, 6 thousand impressions. This one got over 106,000 impressions. I mean, a lot more people saw it, commented, liked it, whatever. But I actually took this. Maybe I think I expanded on it from an email that me and you are one of our emails. I forget when that was. It might have been a couple of years ago. But I believe, if I'm recalling correctly, you said in the email, "Can I tweet this?" And I think you did, but obviously time goes by, we all forget, our tweets and posts and stuff. But uh, so what I said was, uh, 95% of my investors don't know what Sharp is. They also can't tell me what my largest drawdown is. All they care about is the compounded annual return figure. And then it gave a couple quotes of like, are you making me money? If yes, good. Are you outperforming the stock market, which is what most people know and compare everything to? If yes, great. My largest investor knows what Sharp is, but doesn't care. And I said, I'm here to make a lot of money for my investors, actual dollars. Crazy concept, I know. A high Sharp doesn't help them. It more helps me than it helps them. And it can actually be a hindrance by attracting a lot of short-term performance chasers. So I don't know. I don't know what it was about people that like that, but they did. And uh, I don't know. Do you have any initial thoughts on that?
Yeah. Well, I think that's right. I mean, our whole philosophy is you should, in order to let profits run fully to the extent that we should, that maximizes our profit, we don't want to pay attention to volatility of open trades. So the system needs to um, be strong in that regard to where if you don't pay attention to the volatility in the open trades and you have systems that let profits run to the extreme degree, then it's not going to be a problem for you. And I think that we love that. We do that. That's how we trade. Um, I'm skeptical, though, of other people who are not professional traders and lovers of trend following when there are clients in our funds or whatever products they're in. How good are they at staying in there and really doing that? When Niels did his CTA podcast, his CTA series this year of all the SocGen 20 CTAs, he interviewed them all. I loved it. It was fascinating. It was incredibly fun I refer back to them frequently. One of the questions he asked all of them was something about the Sharpe ratio. Do you like the Sharpe ratio? Do you embrace the Sharpe ratio? I mean, my recollection is out of 20, one did. One admitted, oh, of course, we love the Sharpe ratio. Maybe the rest of them, maybe there was other ones who liked it. Maybe there was some who waffled and answered it in a way that made it sound like, to me anyways, that they uh, understood the limitations of Sharpe. But uh, but the vast majority of them, I remember, oh no, Sharpe's no good. Sharpe is not what we should use. But then in further podcasts later on, or another podcast, they're like, that's what they all measure themselves by. And the vol management and correlation management, it's only done. Why would you do it if volatility of the returns didn't matter? And if volatility of the returns matter, and that's the denominator. So of course you got to put the return up there. So de facto, you are caring about Sharpe. So I'm skeptical of everyone in the planet except you and me, and about 4 other people. They sort of love Sharpe. Even the CTAs who grew up understanding outliers, non-normal distribution, skew, positive skew, etc., they now see too much open trade profit, too much of a outlier trade carrying with it increased volatility as problematic. And they pretend to say that, well, it's all about the risk. Risk has increased, but then sometimes they'll slip up and say, it is kind of fun to take a profit. So, nobody wants to do profit objectives and get out and call the tops or call the bottoms and the shorts, but they all like implementing vol management, correlation management for risk reasons. They just love taking those profits.
I wouldn't be surprised if some continue on and go that route as well. Take some off profit objectives or price targets, things like that. Because you do more and more testing, more and more sample testing, you're going to find how often does when I get in at, say, the 200-day high, it makes a 5-year high. How often does it keep going after that? So you know what? If it hits a 5-year high, the odds say, based on 15, 20, whatever, how many trades that's happened before, is just take it all off. I bet you they start going there. I think they will, because you get more and more, you have to keep upping your game. At least that's how they've set up their business, keeping coming up with new ideas just to justify fees and their salaries and their totally overstaffed companies. Like, what are y'all doing all day? Like, we're coming up with ideas. It's like, well, now you've gotten to the point of the cycle where your ideas are awful and they're really bad now. So I wouldn't be surprised to hear some of that talk at some point. Just a hunch, I'll make a low risk bet on that.
Yeah.
Um, the maybe another tweet uh, that got some love recently, a month ago. This is one of mine, but you sure you feel this way as well. The markets are a dangerous place. They're chaotic and unpredictable. I think one reason why many people favor fundamentals over trend following is that fundamentals allow you to tell yourself that you know what's happening and why it's happening. It then tricks you into thinking what will or should happen next. Meanwhile, trend followers like us accept that they cannot possibly explain what's happening, or at least most of the time, so they don't dare take a position in response to their own beliefs or views. Fundamentalists favor potential gains over risk control. Right? They get blinded by the extrapolation of trends. Whereas trend followers care more about risk control than anything else. And yeah, I think I noticed that a lot when talking to really most people. The first thing they say when there's any sort of market talk is producing some story about the economic situation, the election, the inflation, the Fed, yada yada yada. This whole, the usual cast of elements that influence the markets. But it's never about like, well, what are you going to do if you're wrong? Like, what do or how are you going to play this? How much money do you have at risk? So there's none of that talk ever. It's all about the story and the cocktail party type of BSing. Um, I don't know. Any thoughts on that?
Well, I think, it's just for you and me, we love this objectivity of following price and having rules and back testing. And, it's really a different world and different ways of looking at things. We love the diversification and um, not just trading stocks. It's really a different worldview. I think if when trend following gets back to a point where it's very consistent and making money, and we don't have zero interest rates, and we're probably in that period now where we're going to start looking for the next lots of years, I think the trend following will look like it did when in the first 20 years of my trading career, where it did better than stocks, and of course it had less risk and volatility than stocks. I think it'll get back to where people like it more because they'll be swayed by the performance. And so I think over time, it's the trend following is going to get more popular over time, and all the things we take for granted, I think people will just prefer trend following because of it's making more money. I think that's what motivates people. You and I try to look at it from a business and philosophical point of view, but for most clients, they're weak. They don't know what to do. They have bad ideas. Whatever's working recently is what they want to do.
I saw that you recently had a webinar with the Blueprint guys, and I don't know if you're allowed to talk about this stuff, but just going off a tweet that I saw earlier, um, addressing the question of how does your strategy address the challenges of a 60/40 portfolio and potentially increase diversification. Are you able to talk? You're able to talk about that now. You just
Yeah,
can't mention certain things, I guess.
yeah. I mean, I remember one thing I said in there is I don't give a crap about 60/40, because it's not really about 60/40. For me and for you, we want to create these funds and these investments uh, with a strategy that is more of a perfect investment, more of the perfect portfolio. And we don't need stocks. We don't need long only stocks. We don't need long only bonds. We have the stocks. We have the bonds. There's a time to be long. There's a time to be short. 2022, there's no good allocation to bonds last year. It would have been a disaster. But if you wanted to make a lot of money, just be short the bonds. And so if you can't embrace that, you're just going to struggle with maximizing, you know, your opportunities. So to have a permanent allocation to stocks and a permanent allocation to bonds, and then uh, allocate to trend following CTAs, it's pretty dumb. At least for me. I mean, I love stocks, I love bonds, but sometimes I want to be short, and my
Yeah.
positions are going to be dictated by the trend. So I want to build something that eclipses 60/40. And and I've been famous for saying recently, I made this up myself. I really love it, and that is, uh, if you let me trend follow your stocks and bonds, especially your stocks, which most people have no trend following of stocks, indices don't count, then maybe there'll be less crises for you, and you'll need less crisis alpha. The whole crisis alpha is built into your stocks. Trend following is giving you a lot of crisis alpha because you'll be flat or short. And then, of course, the trend following portfolio will give you currencies, commodities, and bonds as well, and crypto, trend following the crypto, long and short. And so it boils down to this one question. I mean, let's just boil it all down to one issue. For all these trend followers, this is who needs to answer the question. That is trend following worthy to handle all of the assets? Is trend following better than stock buy and hold? Uh, is trend following the stocks better than buying and holding the stocks? What are the answers to these questions?
Yes.
They're damned if they do, damned if they don't. No, it's not as good. What? Let me see that research. Yes, it is as good. Well, aren't you telling people that? Why don't you offer them that? Well, I'm just here to collect assets, dude.
Yeah.
This is what they want. They want this. They want a small allocation to CTAs for Crisis Alpha. Okay, go for it. Good luck. And when the tables turn and multiple years in a row, you're making money with your trend following, trading stocks as well in your trend following diversified portfolio. And someone wakes up and says, what the hell's been going on these past 4 or 5 years? Stocks suck. The only thing to do is trend following. Who's been doing this for the past 4 or 5 years? You. You'll be there saying, me. Who's the one person that's been telling us for all these years? You don't need to add, buy and hold anything. Trend following, diversified trend following is way bigger than a small allocation for Crisis Alpha. And so we don't have a lot to lose. We can be the innovators because we don't have big businesses with lots of AUM where we can't trade stocks because it would be too weird. And nobody in managed futures and who invest in managed futures now really wants the perfect portfolio. In fact, they talk now these days about, I'd prefer that you didn't have any stocks in there because I already have stocks. You exist in this world to take care of me and my stocks. I value you so lowly. I value you so little. I want you to fuck up your business and have worse performance for me. And they're like, yeah, we're outside. Just send me those management fees and incentive fees. People should be you hit on this a few minutes ago. I would never apologize because CTAs should be their most prized possession is their track record and those performances. They should take them very seriously and maximize that performance at all times. That's all you're thinking about. Head down, start your little fund. Don't take managed accounts. I've told you this a million times. If people want a managed account, they've got ulterior motives. They don't want what you can deliver. They don't believe in you.
Mm-hmm.
These famous traders, people that people think are really good at trading, they'll put it in people's funds and pay ridiculously high fees. And for CTAs, I'll take a managed account. I want to dictate what's going to go in the portfolio. I want you to screw up your system in your portfolio because I have special needs. Walk away from that. Preserve that track record. Make it perfect. Make it beautiful. Make it the best it can possibly be.
I agree. I think it'd be more, maybe in the end, personally be more proud of your track record, how well you did your job, how well, even if you were, in a recent struggling period at the end of your life, like, well, you know, that's just bad luck that I'm going to be, that I'm dying around in a drawdown, which was likely anyway. But you know what? This is what I would do for the next 1,000 years. I've done a great job. I can hold my head up high, and uh, I'm happy of the team we built. If you have a company, and you know we did right by our investors, things like that. We never managed the most money, or we haven't in a long time. But hey, there's more important things in life than that. And sure, could we have managed more by saying things a little differently? But yeah, that would have gone against our what our real beliefs were, though, and we weren't willing to go there. There's no way we would go there. I understand people will go there, but we weren't, and that I'm proud of that too. And, and I think that comes through with people and connecting with people, and you're attracting good some good investors to work with. It's not just all about, well, how you done the last 18 months or how you been doing against your benchmark the last year or whatever. That stuff is death. It's just a recipe by design. It's all chasing. It's all hot money. It's all come and go speed dating, which isn't very fun. Um, you can't sit. You can't even sit back and do your job. You're busy managing relationships and being a firefighter, having fielding calls from pissed off people all the time, which is not. It's no way to live. I don't care how much money you're making.
Yeah,
So
exactly.
I was gonna look at some other. Oh, you mentioned before we hit record that uh, about one of your favorite investing quotes from Charlie Munger, who may he rest in peace. Real great run, and but I don't know. Do you remember the quote offhand?
Yeah, I mean, I definitely remember it. It's kind of goofy that it's one of my favorite. I mean, I just think it highlights the big difference between what we do and how they invest. And I don't agree with this quote at all as it relates to me, but he's kind of crazy. He's kind of out there, and he's always making these big pronouncements, and people love him and Buffett. And it was just it was more than one, but it was just basically him saying that diversification is stupid. If you want to be average, you can diversify, but in general, averaging diversification is for losers. And I think it's one of those things where you try to figure out how we can both be right. Now, obviously, he's right for the vast majority of people, and I need to convince people how I could possibly be correct as well. So I think the way I looked at it was that from a fundamental point of view, which I kind of don't even really believe in fundamentals, but of course, there's quite a bit of $1 billion of evidence that Warren Buffett and Munger were very successful with fundamentals. That from a fundamental trader point of view, you're ranking these ideas. You've got your best ideas, 1 through 10, and 1 is better than 5, and 5 is a lot better than 10. So going down that list of having 10 or 20 different stocks on, legitimately, if it works, which it seems that it does for some people, that you are doing worse trades. Why would you want to diversify? It's just going to cost you money. You're just going to get closer to that average return, that average indexing return. Whereas with us, we have a systematic point of view with a systematic strategy with rules. We've back tested, and we're following price only. And then all of our trades are pretty much the same. There is no such thing as a trade that is number 1 and number 5 or number 2, number 3, number 4, number 5. No, they're all pretty much the same. Once they hit our entry criteria, we think that all these trades are pretty much the same. Now, they don't look the same because 10% of them make all the money and 60% of them are losers. So you're talking two different worlds here. One where the advocates say that diversification really costs you money because you're not concentrating on your top few ideas. And then our world where you're doing hundreds of markets, thousands of trades, and the diversification really pays off as it relates to finding those outlier trades and smoothing out your performance. What did I leave out?
No, I mean, I think I'm just trying to get into his head, like what he could mean by that. If he's thinking like, all right, you hold a bunch of positions, clearly there's some better than other that are performing better than others. Does he think of it in like a, you know, from a cut your winners, give to your losers in an effort of, well, we want to be more diversified. Like, well, hold on, Charlie. Yeah, because when we take a bunch of positions, we keep what's doing well and we ditch what's not. So we wouldn't be giving to losers either. Is that like kind of? I don't know exactly what he meant, what he means by that, because I feel like we'll probably agree more than we wouldn't, because,
Well, no,
but
it's
they
like I
might.
said,
I don't
when
know.
we put a trade on, if it meets our entry criteria, it's a trade. It's the same as all the other trades. The expectation is the same. Whereas he's saying, no, we don't do trades systematically with trend following. We look at fundamentals. We have a list of stocks to buy from 1 through 10. 10 is worse than 1 by definition. Our 10th trade is as good as our first trade. And so they're all the same. So yeah, if what he does is successful, if you diversify to get 10 or 20 trades in there, he's saying, you're just making my performance worse. There's no reason to. We should just do number one, the number one trade, my number one idea. I've researched it. This company is going to go up 10 times. I tell you what, maybe I won't be right all the time on that one. So let's do 5. I'll grant you that maybe if we do 5, my top 5 ideas, and we're like, okay, that's a different worldview. It's just a different way of, it's fundamental. So fundamental, yeah, you don't want to do too much diversification. Now, parenthetically, we secretly say fundamentals don't even work. This guy's made billions of dollars. It's stupid to say it doesn't work. Of course it works. So why are we saying that? Well, because we're trend following ideologues who believe, well, not only is what we do easier, very few people are as successful as they are doing what they do. Maybe it's not as objective as what we do, but thankfully we can trade hundreds and thousands of markets and we're not diluting our performance because all these trades that we do have the same potential to make money. And it's not a question of at this point in time what's making money. No, because he's got winners, he's got losers, we have winners, we got losers. We don't know, let's say, which ones are going to be the biggest winners. He doesn't really know which one of his 5 choices are going to be the best. But it's the expectation in the future is what we're all concerned with. And he's saying, oh, if you make me take my 5 worst ideas and put them in a portfolio, I'm expecting to make less money. And you put all of we cannot put in any trades in our portfolio as long as they meet the entry criteria that are going to make the portfolio and the performance worse. 2 different worldviews. I like him because he's outrageous and I try to be a little bit outrageous. The difference between us is 90% of the people agree with him and 10% of the people agree with me because trend following is not as universally as accepted as fundamental analysis. And now maybe if the trend followers or me in particular had been a bit more successful, he has his billions, I have my billions, people may pay more attention to me. So my bad.
You talk about a brash man. He's a brash man. And
He was.
no matter
He was
what,
fun.
no matter what day of the week, he was always brash. And
There was another good podcast that I highly recommend to people. It was Howard Marks and Annie Duke. She's a professional gambler at one time. She wrote a book about betting and losing, how losing is a good thing. And of course, we think taking losses is a good thing as well. And usually when I listen to Howard Marks, about 50% of what I read from Howard is I could sort of like select, copy, paste, put it into a tweet, and it sounds just like a trend follower, a risk manager like us. And I did that on that particular podcast with her. There's a lot of good stuff in there. But with Munger, it's like 5%. I have to parse the sentences almost to get some investing wisdom out of what he says. It's really difficult. He's great at his strategy, and I think we're pretty good at our strategy as well.
yeah, he strikes me as like it's a really good. Same with Buffett too. Just very good business, how to run a sound business fundamentals and how to, you know, negotiate deals. I've heard those behind the scenes stories about Warren Buffett where he's some nice old man, but he's on the phone all weekend negotiating a deal point, and he's just a dog on a bone. He's very, very meticulous and ruthless with these things that you know don't make the rounds as a part of his a part of his personality on TV and in conversations. People just think he's just a great stock picker. Like, yeah, maybe he is, but he's got other skills too, and maybe Munger does as well. Where hey, they're not logging into Schwab, typing in tickers and buying stocks. They do things other ways. They got some other skills that you don't have. you know, very 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 good business people.
We're sort of
Where
just contaminated by, as Americans, and as our, given the amount of time we've been on this planet, I'm more contaminated than you because I'm older than you. But I mean to tell you, we cannot get away from the normal conversation surrounding equity markets. It's everywhere, and everybody
Mhm.
kind of says the same thing. And I feel like for CTAs and for trend followers, um, who started out in futures with currencies, commodities, stock indexes, and interest rate futures, I feel like we got that down, and we we trade all those markets, and we trade most of them. We look at liquidity, we look at this diversification, and then we just do these trend following trades. And we don't think two things about it. Now, maybe if we talk to an expert in currencies and told them what we did, they can make us feel bad, or a bond expert. But we looked pretty damn experty last year, didn't we? Short those bonds. We looked
Yeah.
real experty. However, when it comes to stocks, I feel like there's so much more unsolicited information. You don't even have to talk to an expert. You just hear it every single day with your friends or CNBC or whatever. And I start looking to put these stocks in my portfolio based upon their diversification qualities and what these companies do, not knowing anything else about them. And so you've seen me do this, buy, buy, buy. And you're like, what the hell? Where did he come up with these stocks? And I'm just telling you, it's just like cocoa. I know nothing about it. And I think I have a different feeling though, because I don't talk to cocoa experts all the time. And so I don't even think about how, dude, you don't know jack shit about cocoa. Yeah, but look at all this money I've made. But then when you buy these stocks, though, you're like, there are people out there who know about this stock, and they're not buying it because they say it's overvalued, or they are buying it, or they bought it a long time ago. And you mean to tell me you really think you put this thing in your portfolio, it hits the breakout, and you go long? You really think? And I'm like, yeah, I really do
Yeah.
think. I really do think this is the way to do it. But we're influenced so heavily by the 99% that don't do it this way describe stock trading in a different way. When I get with my friends who are just friends, they're not in the business, they ask me, I'm tempted to say, hell, I made a lot of money in this particular stock. I'm like, no, no, no. Because, I don't know anything about this company. They're going to go, what's wrong with you? How can you make money and you don't know anything? It's kind of funny. What do you think?
That's I think I think that's a great way to end. How do you make money and not know anything?
That's right. Well,
Kind of right
here's
to
the
the top.
difference. Here's the difference, though. With all the other markets, it doesn't seem to bother the CTAs very much. With stocks, I think it really bothers them. And they're like paralyzed because I'm taunting them all the time, trade stocks, and they have no interest.
Yeah.
And they just keep going with their little indexes. And yeah, but I'm just saying, you can't have it both ways. If you feel bad about knowing about trading stocks that you know nothing about, you should feel bad about all those other markets because you don't know anything about them as well, or vice versa. Suck it up, put them in your portfolio, trend follow them, and just be 100%. You don't know anything about anything. I bet a lot of them too, though, would add fundamental information to the trend following, and that would just be a total disaster.
I don't doubt that it's already happening in their
It's
selection
already
methods,
happening.
or we're going to
Yep,
get there. No doubt.
already happening.
Absolutely no
Yeah,
doubt.
yeah.
People are too
Let's
smart for
talk.
the damn good.
Let's talk about that next time. Too
Next
much
time.
information, too smart. How do people handle
This
equities? Yeah.
that's going to be the name of this episode. How do you make money and not know anything? That's it right there.
That's right.
That's too good.
Wow. That's great for our resume. That's just fantastic.
Oh man. Well, this was lovely. Uh, want to get back on the weekly schedule again. If
I feel like we're like the Aaron Rodgers and what's that guy he's always with on a podcast?
yeah,
That wears the cutoff shirt.
he was a kicker or punter or
He was a
something like that.
punter. Yeah.
Yeah, yeah.
Peyton Manning's punter. Pat something? I don't know.
Oh, Pat McAfee.
McAfee. I
McAfee.
feel like let's see. Am I McAfee or am I Rodgers?
Uh,
I don't know.
no, we're. I don't know. No, we're not them. We're
Okay.
okay. We're like them, but we're not. We're not them.
We're not them. Okay, that's
Yeah,
probably safer. We're not
yeah,
them.
yeah.
All right. Good to be with you. Have a
You
good weekend.
too. You too as well. Thank you,
Okay.
everyone. See you next week.
See you
Bye.
next week.